edition of the London Session Open. Today is May 1st, 2019, and it's 9:35 a.m. in London when I'm recording this market update or hosting this live. I want to welcome you so much, and if you have any questions during the webinar, you're most welcome just to put your questions in the chat box to your right to be able to participate. I just need to have a YouTube account. Very straightforward. It's free also to create, so feel free to do that as well. Don't forget to hit that like button. Let's get this presentation trending on social media and on YouTube, of course. Okay, today is Fed Day, and it's also the day after we have the breakout here in also the price trading above the trend defining level, which is the April 24th high, and unfortunately back into the old range. So you know, over the last few days I've been working with the idea that we have like an ascending triangle here, and the fact that the market is up here just firmly back into the pattern suggests that that could have been a false move. Obviously technically, you know, we're still in a downtrend, but the way I manage my risk is that I will give every trade just a few pip to develop, and that's how I get those really good risk reward ratios. However, sometimes, especially when the market is sort of choppy like this one, it will just lead to sort of small losses, which could of course accumulate into something bigger, and it just becomes a difficult time to trade. So what I try to do is that when it doesn't work out, I just sort of focus on some other market. But here again, sort of the trend remains bearish for now, using sort of normal sort of trend defining levels and trends, and we are creating low and lower highs, and this is sort of the last swing high, and then you have this level up here. So I would assume that sort of if I had to choose, and people are going to ask me, where's this price going to be in the next few days? Well, I would say probably down maybe at something like 111.50 or something like that, or pretty much around the same level, or down here over the next few days given the trend. And I think if we do take out something like 1262, we might just go a little bit higher, but I don't really think it's going to go trading much higher. Today is, however, the Federal Reserve or the Fed Day, and that meeting and those figures should come out this afternoon. So this is the April meeting. So as you can see, April-May meeting. So you can see here, I think there should be no updates here. So what they do is that they publish a statement, which is something just like this page here, which is the last statement. So people read this and then they just compare what happened here, compare with the is any changes here compared with what's happened in the past. It's very straightforward. It's actually not even a lot of text. So I strongly suggest that you start to read this if you're not doing that already, instead of, you know, going to Bloomberg or other places. It's nothing bad going to Bloomberg, but read this first and then check quickly what they're just saying. Like you check just the headlines, like 10-15 seconds at most. Then you come here, read this, and you get a better take really what's going on in the market. Now the other thing is that they produce these projection materials, but that doesn't happen that often. It just happens here. It's going to happen in June, it's going to happen in September, and then it's going to happen in December. So if we take a look at the projections for the market, so by the end of this year, they anticipate economic growth to be at 2.1%. Well, the first quarter GDP growth was what, 3.2. So obviously, if that can maintain itself over the whole year, then, you know, we'll exceed that target. Unemployment rate 3.7. Top of my head, I don't even remember. I do remember, but I'll actually check that out. U.S. unemployment rate. Trading economics, I think it's 3.6, 3.7, so it's not like huge difference. 3.8, so pretty much on target for that as well. PCE inflation, I think we're slightly lower than that. We had some figures out just recently, and we are definitely slightly lower than that, so that could be a concern. And then the federal funds rate by the end of the year should be at 250 basis points. Let's go to CME FedWatch. So for the end of this year, actually, well, yeah, according to this one, then if it should be at 2.4, I mean, and right now the price is at 225, 2.50. So technically, at least if we just read this like that, it should just be unchanged, no change in the no real rate hikes. But I think in the dot plot, which is this one down here, I think the average, well, actually, most people sort of anticipate the interest rates to remain where we are right now. And you have 1, 2, 3, 4, 5, 6 members projecting slightly more of higher interest rates. Now, what's happening here, I think, is that the Federal Reserve, they're clever enough. They're not like the newspapers and Bloomberg and CNBC and traders in particular that sort of changed their view from just one day to another. Rather, every quarter or so, they will produce these projections, and that's when they change their minds, and that's when they make any major changes. So for this meeting up here on the 31st, there's probably not going to be, well, they're not going to publish anything. They're just going to publish that statement, which means that there's not going to necessarily be a big reaction. But then what we want to see in June, if they make any changes to their inflation projections, or sort of start to suggest, that it's time to be slightly more dovish. I think that could potentially be something. But for now, there's probably not going to be too much of a change. And they're probably just going to say something like economy is doing relatively good. Inflation has moderated a bit, but in the long run, we still think inflation is going to be strong. Something like that. I think that's what's going to be happening today. And if that is the case, it may potentially cause a little bit of a dollar push, because you look here, the current interest rate is at between 225 and 250, and there's just a 35% likelihood that that's going to be the case by the end of the year. In fact, some 40% think they're going to cut rates with at least 25 basis points, and then you have some 19% that think they're going to cut 2 times, and you have some 4.4% that think they're going to cut 3 times. So that's quite of a gloomy outlook, I would say, for the market. But again, I know inflation picked up a little bit, and if you think about it just rationally for a few seconds, crude oil is up with about 50% in the last few months. Obviously, that's going to translate into higher inflation, the same way as the sharp decline we saw is translating into lower inflation right now. And if things sort of just moderates themselves, we're still going to have a relatively good inflation figures. Economy is going to be relatively good. Unemployment rate is not going to be that difference. So then people are going to say, well, why are we projecting rate cuts? And that, again, can be a booster for something like the dollar. Of course, this is the macroeconomic outlook, and this is just the way people are positioned. But sometimes what they need, the markets, they need a bit of a nudge, which is, again, the Fed either staying put and saying, look, guys, you're getting this wrong. And then on the other side, you have ECB, which is probably going to introduce TLTROs, which could potentially cause the market to, turn bearish on the ECB. But that right now is just my opinion on the market. And the market itself, obviously, from a longer run perspective, we are moving lower, without a doubt. We started trading here somewhere, and the market is on the year down with 255 pip. But it's not a lot, and it's very highly volatile. So we just need to wait for the market, at least the technicals, to start to agree with us. And I was bearish on the break to the downside, and I was happy to put my stop loss up here, or that was my trend defining level. I didn't trade this directly. I was long the dollar index, but that, as you can see here, we had a nice little breakout. We had a head and shoulders with a head, left, right shoulder. You had that break here, but you can see the whole thing just tumbled back into the pattern. So I got stopped out here for a loss of 1% on my capital. And yeah, this could bottom out. It can go to the upside again. And if that happens, and sort of people start to agreeing with my macro fundamental point of view, then that's when I start to get involved. And that's key, guys. That's key to survival. Like the perma bears, especially in stock markets, which we're going to talk about in a few minutes, It doesn't matter what you tell them. They always just see the problems. It's called confirmation bias. This is just one of the biases that we humans have. If you have a view like, you know, like racism, for example, you know, if you dislike certain people or certain religion and vice versa, whatever, you're probably just gonna look for things that sort of converse with your view. You know, if you, for example, don't like the FX industry or the CFD industry, which obviously you don't, because otherwise you wouldn't be here. Uh, you know, you would probably say if you didn't like it, then you probably would just go on like online website like, oh, FX is a scam or whatnot and so on. At the same time, you know, if you are a short-term trader, then you're probably just gonna align yourself for short-term traders and so on. Everybody has this issue. But what is interesting with trading is you can see on your trading account in black and white if you're doing things good or not. Because if you're doing things good, you're making money, and if you're doing things bad, you are losing money. And then there's a little bit of a challenge with that though that you need to remember, and that is that just because you're wrong for a few months or even a year, it doesn't necessarily change things. Doesn't necessarily mean that your strategy is not working, unless of course you get a margin call before that. But to give you an idea, even some hedge funds, maybe they'll up quite a bit for a few years and then they're down with 10% the second year or 15 for first year and then second year, and then they have these booms and busts. And I think I did a video on that not so long time ago. See if I can find that. That sort of shows how a fund that's been active since 1980, I think it is, has been doing, and it doesn't always have profitable years, but in the long run, it's beating markets in a big way. So technicals, fundamentals, can marry those. That's always good. But the technicals many times is more important. So that's why even people don't even bother to read up on fundamentals many times, just because of that. And if I had to say who's more frustrated most of the time, is it the macroeconomist or is it the technical analyst? I would say it's the macro analyst, economic analyst, economist really, rather than the technical analyst. All right, so back to the technicals now. Again, remains bearish below 1262. You know, maybe look for some reversal candle, some indication of this rolling over. I think potentially it's going to go down again. GBP versus the USD took out that 130 level. In fact, it's a 130.66. So now I'm actually turned bullish here. This market's gone up quite a bit though. Don't want to be buying it here. What's happening is that some people went short, and then literally these people are short of buying back those positions, and they're just getting under a lot of pressure, getting out of the market, and that's what we have in the situation here. We can take the fib from the low to the high. I think the market can go down, and then maybe down here when we'll look to start to get involved again. Here is the dollar versus the Japanese yen. The market is, I think, still bullish and creating higher and higher lows, so it makes sense to remain bullish. This has just transformed into a funny looking head and shoulders pattern, inverse head and shoulders pattern, more complex one. And above 110.81, I will remain bullish, and I suspect people down here will try to buy. They risk about 40 pip or so. If we go up to the high, they make about, I would say about 100. So that's not that bad from a risk ownership perspective. If we actually trigger that breakout even higher, what can motivate this? Well, high stock markets, of course. Let's take a look. This is the S&P 500. And yesterday here we had a very nice little dip. So you might remember we said look to buy at 2925.4. We dipped into that, quickly moved upwards, and then now in profit. I think if you would get out of this position right now, you would almost have a risk reward ratio set up of I think you're looking here at 2 times your money. So that's a good little profit if you've been if you're trading short term. I think if we revisit the buy zone, I think people are gonna buy. And again, I'm just following the trend. I've been bullish for quite some time, and I will continue to be bullish until proven otherwise. German DAX is closed today. It's a bank holiday, so a public holiday in Germany, so there's not a lot of activity. Most likely though, if the S&P 500 maintains its gains, we're probably gonna gap higher when we open up, and could probably be very close to that target that we discussed here on April 2nd. And the only thing we didn't cover is crude oil and gold. So this is gold. So if I'm right about the view on the Fed, I still think we're gonna trade lower, but obviously it's that messy sort of setup here. I shorted myself at 1277 or 1278 or so, and I shorted a bit more down here. And unfortunately, well, what happened with the first one is that stop was at entry, so no loss on that one. In fact, a little bit of a profit. And then here I added 1% of risk. The whole thing went upwards, and I got stopped out for about 1% loss. And this happened on April 25th. Now, looking at this today, the market, I think, still can look to reverse here. It did not trade above yesterday's trend defining level. I have now reduced the trend defining level a tiny bit to just above yesterday's high, and I know it's going upwards here, but if you look at the 30-minute, it could be forming a head and shoulders. So this is your left shoulder, this is your right shoulder, and this up here, guys, is the head. Okay, and the break here, which I already attempted today, so far a false move, but I guess the next time when we if we do indeed trade below today's low, I think that will confirm that little head and shoulders setup, and that suggests we could potentially decline down to something like 1268, and then we'll see if this little short-term setup aligns itself with the big picture, and if it does, then you're looking at a very, very good risk-reward ratio setup. You're looking at something like about 6.7 times risk-reward ratio, which is not that bad. Finally, here's crude oil. And, you know, crude oil had that big rally. And since then, literally since the beginning of this second week of April, it's just been trading sideways. So I don't have high hopes about this market. I think it was going to trade sideways for longer. And I think it makes more sense to take a step back, let everybody else sort of figure out what's going to happen. I think it's going to be choppy for a bit, and then eventually we'll see some sort of a bullish or bearish breakout. And the levels I would watch would be 62.32 and 66.60. And that's pretty much it. So got a question here from Hi. If you guys have any question, put it in the chat box as well. If you're looking at this right now, I can see there's 7 people watching, but just 3 likes. So we're doing something wrong here. Hit that like button. Help me to see this presentation grow. The more you share, the more I care. You like trends. So if this trends, we'll do more of it. Some of you guys might know, I used to do, when I was at Daily FX, used to do the morning update plus the afternoon update. So I used to do 2 videos a day. Don't do that anymore. Because of, not because it didn't necessarily was not a popular video, because it was, especially with the Australians, because about the time I was doing that video, they could watch that, because a few hours later it was time to for the new training day in Australia. Yeah, let's take a look here now. Got a question. Hi says, what do you think of the correlation between gold and platinum? Maybe the reason why gold has difficulties is down because platinum is rising. That's a good question. I've seen that before. My memory is a bit bad right now, but let's do a search. What is platinum used for? Platinum is used extensively for jewelry. It's mainly used, however, as catalyst converters. Yes, I think this is correct. So I think it's used primarily for catalyst converters, and that sort of, if I remember correctly, sort of the bulk of platinum is used for that. Don't remember exactly. So I guess it's more linked to that than industry specific, rather than sort of a correlation between gold and crude. So it's not that one is replacing the other one. Maybe in people's mind, speculator that is, they're buying platinum, but it's not. It's not for a long. Um, I don't think it's for. Let me just load the chart first. I don't think it's because of. It's just for speculation purposes. You said platinum, so this is platinum. Let's put gold on top. Are you sure you mean platinum? I think it's palladium that is rallying significantly. That could act like some sort of a problem or like substitution effect. But this is platinum versus gold, and platinum is the orange line. Sorry, gold is the orange line, and platinum is the blue line. And obviously they're highly correlated, as you can see, but sometimes there's big divergence. And I think it has to do again with the usage, what they're used for, rather than anything else. There's, well, I think it's palladium, right? So this is palladium, and then we have gold. So palladium, I think, is what some people are sort of substituting. It's not that they're substituting gold, because I think palladium as well has some specific usages. Here you do have, at least this is 1998, so very certain palladium, so this is not necessarily linked. But I know here that from pretty much this section here, palladium prices were at 870 and then rallied by 70%. I totally missed out on this little rally, but a massive rally. And here I read articles that people say that people rather invest in palladium than gold, but it's just for speculative purposes. I don't really necessarily think that the use, this actual industrial use for that. Apparently in catalyst reactions as well. This is interesting. Is palladium worth more than gold? So this is something that people are talking about. Palladium is now more valuable than gold. What is palladium used for? Yeah. So when you have these sort of situation where something is rallying strongly, I mean these have some influences, without a doubt. For this by itself, it's actually quite interesting because it has a strong rally and then you have that pullback, and it's up with 70% in a short period of time, so it could easily be a bit of a bubble. It's definitely, I think, what will be called a parabolic bubble, and they're different views on this. And I know one guy that's been around for some time, and he sort of claims that when you have something like this, which sort of grows faster and faster, when that bubble pops, you will have like a 80% decline of that rally. So let's add that. This is 78. So let's make that 80. So 99.92. call it 1,000. So if it's gonna retrace 80% of its move, it's gonna be back down at 1,000. And this looks to me like, if you remember your basic LED wave principle, you got yourself your A, and then you got yourself that B curve, and now you got yourself that C curve, and that C wave, no curve, wave. This could as well be interpreted like some sort of a funny looking rectangle, or I guess a failed triangle to some extent, where you had that. We can treat it as a triangle. It's not gonna matter too much. You can take the base here, and then you have the break here potentially triggering that. Now I would not trade this triangle. It's just useful for that target. Again, you can sort of try to even suggest maybe that this is a rectangle. The targets are relatively similar. What's interesting here though is that you have that break. If you have that break at 1323, then you could potentially see further decline in the next few days. Potentially on the break here, you get that decline. And then again, it's always about that risk reward ratio. So maybe, I'm just guessing here, we have the break. Stop will go just above somewhere here, so risk maybe 2.5%. If we hit that first target, you're gonna have a 1 to 83 times risk reward ratio. If we trade lower, you're looking at, if we trade to the target, you're looking at a 8.71. Now let's be realistic. It's not gonna go all the way down there. If you take simple fib, maybe down to the third fib, so then you're looking at a 5.5 risk reward ratio. And this is a little bit how I work. So I look across all the different markets, because I look at more than just the markets we look at here. I look at about 100 markets, I think, and then try to find, eventually you find maybe 5 or 6 markets that are looking interesting. You put your risk reward ratios in, figure out, okay, all the decent risk reward ratio, a decent risk reward ratio, at least 3 if not 4 times your money on a break on the daily. And then you just wait for those setups to trigger, and then that's it really. Okay, I think we're gonna wrap things up. So we'll cover a lot of ground today, and I hope that's gonna help you and support you in your trading. If you need more support and you need really good spreads, don't forget to check out ATFX, especially if you're in Europe, or even if wherever you are in the world actually. If you happen to be in Europe, then obviously we have the FCA registered business. You get things like decent leverage, very tight spreads, and you get coaching as well. If you're not based here, then ATFX does offer, for example, if you're in the places like the Middle East and places like that, ATFX does offer, has like international branches as well, with less regulation, less security, but then higher leverage and other possibilities as well. A little bit like it used to be before last year, before ESMA, but that's only if you're international. If you're European, then you're only they only accept the new ESMA rules, as you know. Okay, so you have that, tight spreads, coaching from me, and you have as well some educational courses coming up as well. If you want to know more about that, just send me a message. You can reach out to me via alejandro.zambrano@atfx.com, and I'm also available on Twitter at alexfx00. Just search for that handle and we can catch up, we can speak, and if you have any questions, I can see if I can help you. Have a good day, guys, and thanks so much for watching, and don't forget to hit that like button. Doing much better now. 7 watching and 6 likes. Like that. Thank you, guys. Bye-bye.